Hi there. In this video, we explain the 2026 budget changes to high-income child benefit thresholds and what they mean for UK families.
For years, a tax charge has been quietly draining money from thousands of UK families. It's called the High Income Child Benefit Charge, and you know what? After more than a decade, it's finally getting a massive, much-needed overhaul. So let's dive in and see what this actually means for your family's finances.
Right, let's get straight to it. If you're a parent in the UK and your own personal income is tipping over that £60,000 mark, you need to listen up. For far too long, this, sneaky tax charge has been clawing back child benefit from families who often didn't even know it was happening. Now, the rules have finally changed for the better, but being in the dark about how they work could still cost you. To help us unpack all of this, we're using some fantastic insights from the experts over at My Tax Accountant. They've really broken down these crucial updates, which actually started back in April 2024, but are going to be fully bedded into the tax system by 2026. So here's our game plan. First, we're going to look at the old tax trap and figure out why it was so problematic. Then we'll get practical and see exactly how the new rules work with a real-world case study. We'll also cover the brand new, much simpler way to pay, expose a pension pitfall you absolutely need to know about, and then wrap everything up with a straightforward action plan for you.
First up, let's get our heads around the problem we're moving on from. The child benefit tax trap, as it became known, has been a massive headache for parents ever since it was introduced way back in 2013.
So what on earth is this charge? Well, in a nutshell, it's a tax designed to take back your child benefit once just one person in the household earns over a certain amount. And the really key thing to understand here is that it's not based on your headline salary, but on your adjusted net income. That's your total income after things like your pension contributions have been taken off.
And here was the big problem. For more than 10 years, that income threshold was totally frozen at £50,000. Now, as wages naturally went up over time, hundreds of thousands of ordinary families were suddenly and unexpectedly pulled into this tax net. It's a classic case of fiscal drag. And what's worse, it forced people who were just regular employees into the complicated world of self-assessment tax returns, often just to pay this one single charge.
But thankfully, the 2024 budget brought some long overdue and very welcome changes. So let's take a look at exactly what's new on the table. Just look at this comparison. It shows how big a deal these changes really are. First off, the starting line has moved up from £50,000 to £60,000. But honestly, the real game changer is the taper rate. Before, you lost your entire benefit over just a £10,000 income range. It was a cliff edge. Now, that range has doubled to £20,000, stretching all the way up to £80,000. It's a much gentler slope, giving families a lot more breathing room. And this chart shows you exactly what that means in practice. Let's say you're earning $65,000. You now get to keep 3/4 of your benefit. At $70,000, you still keep half. It's amazing when you think that under the old system, you'd have lost every single penny at these income levels. It really does make a difference.
Okay, all that theory is one thing, but let's make this really practical. We're going to walk through a case study together to see exactly how these numbers play out in the real world.
Right, let's meet the Millers. We've got Michael, who earns £76,000 a year, and Sally, who earns $34,000. They have 2 kids, and Sally is the one who actually claims the child benefit. Now, because Michael is the higher earner and his income is over that new £60,000 threshold, he's the one who is liable for the tax charge.
Okay, let's follow the math step by step. First, you can see their total annual child benefit comes to just over £2,200. Next, we see that Michael's income is £16,000 over the new threshold. Because of that new, gentler taper rate, this means he has to pay back 80% of the benefit as a tax charge. But here's the absolute key takeaway. After paying that charge, the family is still left with over £440 of benefit for the year. That's 440 quid they simply wouldn't have had under the old rules.
Now, here is a really powerful professional tip for you. Remember we talked about that adjusted net income? That's the number that really matters. Well, you can actually reduce it by making pension contributions. For someone like Michael, putting a bit more into his pension could easily drop his income below a certain point, potentially slashing that tax charge or, maybe even wiping it out completely. It's a fantastic and perfectly legal tax planning strategy. So the other huge piece of good news is all about how you pay the charge. For many people, the days of being forced into doing a self-assessment tax return are, thankfully, coming to an end.
So here are the key dates to have in your diary. The new higher thresholds are already in effect. Then from summer 2025, HMRC is rolling out a new digital service that's going to let people pay this through their regular payroll, pay as you earn. And it's also now been confirmed that the very confusing plan to move to a household income assessment has been scrapped, which honestly is a massive relief for a lot of people.
So, how do you actually get out of doing self-assessment? Well, it's pretty simple. As long as you're an employee with no other complicated tax affairs going on, you should be able to use the new system. You'll just need to register online, either through the gov.uk website or the HMRC app. And if you've been filing a tax return only because of this charge, you can just give HMRC a call and ask to be taken out of self-assessment. It should really simplify your life.
Right, this next bit is incredibly important, and it's something that is so often overlooked. This is about why you should always make the claim for child benefit no matter what. And the whole reason you should always claim is captured by this one number, 35. That is how many years of national insurance contributions you need to get the full state pension. See, in the past, to avoid all the hassle of the tax charge, loads of parents just stopped claiming child benefit altogether. And as we're about to see, that was a huge mistake with really serious long-term consequences. Here's the did you know part. When you claim child benefit for a child under 12, you automatically get national insurance credits for that year, even if you're not working. This is absolutely vital, especially for a stay-at-home parent. Here's the trick. You can choose to claim the benefit, but opt out of receiving the actual payments. This means you completely avoid the tax charge, but you still bank those incredibly precious NI credits towards your future pension.
Now, the government knows that people have missed out on this, and they are planning a way for people to claim backdated credits. But here's the bad news. That system has been delayed, and it isn't expected to be ready until April 2027. This just makes it even more critical to act now. You can't fix the past just yet, but you can absolutely protect your future by making sure you have an active claim in place right now.
So we have covered a lot of ground there. Let's boil it all down into a simple, clear action plan you can use.
Okay, here is your final checklist. First things first, figure out your adjusted net income to see where you stand. If you're over that new £60,000 threshold, decide how you want to pay the charge, the old way or the new, simpler PAE system. Most importantly, please always have an active child benefit claim to protect those vital pension credits, even if you opt out of getting the cash. And if you stopped your claim in the past, get it restarted. And look, if you're at all unsure about any of this, getting some professional advice is always the smartest move.
And just a quick but important reminder, this has been a general guide to help you get to grips with the rules. Everybody's financial situation is different, and tax laws can and do change, so it's always best to get advice that's tailored specifically to you. And for that kind of personalized expert advice, we'd recommend contacting the team at My Tax Accountant. You can see all their details on the screen right now. They can really help you navigate this for your family's specific situation. Thanks for joining us for this deep dive. Make sure you subscribe for more breakdowns of the financial topics that matter. A little bit of knowledge about these rules today could make a huge difference to your family's financial future.